Hey, I want to welcome you guys back to another episode of the AWM NFL Podcast. My name is Riccardo Stewart, and I'm your host, and I'm joined with my friends Zach Miller, Sam Acho, and Jeff Locke. We got an opportunity to talk about, I think, some very interesting things, because so often we've talked about human capital on this podcast. We've talked about having the right insurance, estate planning. We've talked about so much stuff that your money touches that we haven't completely explicitly talked about the thing that most advisors want to talk about, and that's investments. And so the last podcast, we really talked about that. But before we could even just talk about investments, at some point, the phrase that gets used a lot is the market. What is the market doing? What is the market saying? The market. And sometimes people are like, I have no idea what the market is. It's kind of like this nebulous thing. Like in the football world, especially at this time, we think about the market being, it's free agency. I need to test a market, see how much somebody will pay me to maybe go to their team as opposed to staying for my same team. So before we jump in, I'm going to lock in on the professor. So Jeff, would you give us a brief history and maybe even a definition on, in the financial world, what is the market?
For sure, I'm going to stick with your example of the free agent market. Like all the free agent market in the NFL is, to be frank, a place where players are bought and sold, right? Or people bid on players. Who's willing to pay the highest price for this free agent amongst the NFL teams, right? So the market, the stock market, financial market, the same just for investments, right? Who's willing to pay the highest price for an investment, or who wants to sell an investment? Right. And the reason it's called the market is because back in the day, before internet, before we had access on our computers to buy whatever we wanted, you had to call someone in New York or Chicago and be like, yo, I don't want this stock anymore. Can you try to sell it? Or actually, I want to buy this stock. And then they physically had to go to a location with other people doing the same thing. They were called brokers or traders and say, hey, my client wants to sell this stock and they want to buy it. And they'd haggle on price. So they go to the market, just like you go to like a farmer's market, and actually have to trade the pieces of paper. That's why it's called the market. And there's thousands of different kinds of markets around the world, but that's the one that we operate in.
Just a bonus question for you to tag along, Jeff. Is there any movie that comes to mind as you visually explain that?
Zach might actually know one better than me. One called Boiler Room, Zach? Is that one of them?
That's what came to my mind.
Trading Places.
Yeah. Trading Places.
Oh, nice,
Classic.
nice. Just seeing them running around, I could see it. Well, okay. Thank you for that, Jeff. That's helpful. Sam, I'm gonna go with you now. We talk about the public market and the private market. I think most people are used to hearing about the public market because the first thing that comes to mind is Starbucks or Apple or Microsoft. Can you explain the difference between the public and the private market?
There are three main differences between the public market and the private market. Number one, it's access. Number two, it's regulation. And number three, it's the investable market. We'll start with access. So when it comes to the public stock market, the access is to everyone and anyone who wants to join in the public market. As Jeff said on our last episode, you can take you about 5 minutes, log in, boom, get an account, and boom, you can be a part of the public market. There's a difference between the public market and the private market. The private market, in order to get access to the best investments, you have to be what's called a qualified purchaser, meaning you have to have at least $5 million of investable assets. So if you want to get the best of the best when it comes to the private market, there's levels. You got at least 5 million of investable assets. That's number one, access. The second difference is regulation. And so when it comes to regulation, when it comes to the public market, it's everyone has the same information at the same time. So there's no kind of secrets. Everybody knows everything. All the information is out there. You can go online, look it up, figure it out. Everyone has the exact same information in the public market. But there's a difference in the private market. We're talking about that qualified purchaser. When you're a qualified purchaser, essentially they're saying, hey, you know what you're doing. And so what they're saying there when it comes to regulation is buyer beware. Meaning you may not have all the information. There may be stuff that you know or you don't know, but we think that you're qualified enough to get in these investments. So buyer beware. It's not the same information at the same time. No, it's, hey, you're on your own. Buyer beware. But the last difference between the public market and the private market, it's when it comes to essentially like the amount of investments that are available. So for example, only 2% of all investments exist in the public market. You're like 2%, but all these, stock market, yes, 2%. Now, mind you, that's 55,000 companies in 48 different countries. But it's almost like that iceberg example. You're all seeing those pictures of the iceberg. You see the tip of it, but there's so much more below. 98% of all investments exist in the private market. And so just to recap, the differences between the public market and the private market, number one, it's access. Number two, it's regulation. Number three, it's that amount of investments, the amount of investments that you can invest in there. And so those are the differences between the public and the private market.
Hey, that is absolutely helpful. And I think that just that number, one, just the image of the iceberg, that only 2% are public, which is what most people know. And there's 98% of what you don't know. And you said it, there's levels to this. So Zach, if I wanted to level up, what would I do, and what kind of wisdom would you give me in terms of understanding the private and the public? Because let's just be honest, we all know on this. When our clients call to talk about investments and they want to talk about the market, there's one particular person that they call that they know they're going to get a depth. Because with Zach Miller, 2% is in the world that we live, and 98% is in the world that's deep into investments. And so, Zach, why don't you give us some wisdom there between the private and the public?
Well, number one, I think everyone should know that the public stock market has been one of the most incredible wealth creation tools in its history, and the data is undeniable there. The U.S. stock market has averaged over almost 100 years, over 10% returns annualized. And so that's a massive amount of wealth that has been created by investors that have had the opportunity to invest for long periods of time in the public stock market. So the public stock market's great. It's regulated. Anyone can get access, like Sam mentioned. You can get in there and become an investor early. People with 401ks get access to those growth assets early in their careers when they have 401k matches. All those things are great. The problem is those, not everyone gets those returns. You end up with some people that, they bail on their strategy. They sell when the market's down and end up hurt by it. So not everything is you can't just blindly trust the public markets, but they are still a very good tool. The private markets, like Sam mentioned, that kind of access matters. If you don't have access to the best investments within the private markets, you actually should just avoid the private markets altogether and just stay in the public markets, because the private markets is where people lose the most amount of money because they don't understand it. They're considered sophisticated investors, right? So you have those thresholds of money that you're worth. All of a sudden, you're supposed to be sophisticated, but if you don't make the right choices in those investments, you can actually have your money tied up for long periods of time, which is just called illiquidity, and then not get returns as good as the public market. So it's very much buyer beware on the private market side. If you do have the right access, if you do have the right exposure to the best investments, the best companies in private markets, those returns can be up to twice as much as the public market. So no risk it, no biscuit. If you want to really build that wealth fast, it does make sense to do private markets. I wish I did venture capital earlier than when I started. All those things do add up to the power of compounding. And then I'll just finish off with investing is actually not gambling. Gambling, there's an expectation that you lose money. Investing is the opposite. Investing, you are Vegas. You are the house. You have an expectation to make money. The capital markets across the world, they work. The investors expect to make money above what they put in their investment. And if you do that for long periods of time, you have a tremendous amount of wealth creation. But you have to be a long-term investor because anything can happen in the short run.
Love that. Phenomenal answer. So in coaching, sometimes you go, this guy played in the NFL. He played 10 years, so he must be a good coach. And we all know just because you did it doesn't mean you actually know how to coach it. And Zach, it seems like what I heard you say is when it comes to this qualified purchaser, like they expect for you to be sophisticated. But the reality is just because you have the money doesn't mean you really know what's going on. So that's important. And there was something else you said that I'm going to actually see if Jeff can even expand on it. You talked about how one of the best wealth creation have been investing in the public market, and that over 100 years that it's been able to give 10% annualized return. Jeff, make sense of that.
Yeah, 10% doesn't seem like a lot. First, before I start, like just two huge shout outs. Like Sam and Zach went full professor mode today. Like I didn't say anything. These guys are just dropping all the stuff. I was just kind of sitting back. It was great. Also a little bit hungry after the biscuit reference from Zach. So I had heard it that way before. But 10% return like doesn't seem like that much. Right? It's like, oh, cool, 10%. So if I invest $100, it becomes $110 the next year. Right? But the key is when you invest that $110 again, it doesn't just become 220, it becomes like 225 or a little bit more. It's the power of compounding, right? So you keep doing it. You keep doing it. You keep doing it over time. And when you look at 10% over like 20, 30, 40-year time periods, you stay invested and keep doing it, the numbers are absolutely massive, right? The people that fail are the ones that are like, oh, 10% ain't enough. Like, I'm going to try and like get a little more risky. Let's go like shoot for 2025. I'm going to really bet on this one company because I think it's going to hit. And then you wipe yourself out and you start back from zero, right? So early in your investing career, you're going to see these small little gains, right? Like, oh, cool, I got 10%. Oh, cool, I got 10%. But 20 years from now, 30 years from now, you're like, oh, those 10% really added up.
And if I could just quickly just add one thing as I'm listening to the professor teach, it's almost like working out. Like as we train, and the athletes will get this early on, whether you're working on drills, trying to gain weight and we're trying to gain muscle, maybe you're working on your speed drills, maybe you're working on running routes, maybe you're a pass rush, working on your pass rush drills. Early on, it doesn't seem like it's working, but day after day, week after week, month after month, year after year, decade after decade, all of a sudden, it's almost unimaginable how far you've come. And that's the power that Jeff just said of investing and the power that Zach alluded to earlier of compounding. Like if you just stay invested and stay committed to the plan, all of a sudden you will see those benefits. You may not see them early on, but after days, weeks, months, years, and as a lot of guys listening, you're young, decades, all of a sudden that the gains and the growth will blow your mind.
Because I've enjoyed this conversation. We're definitely going to have to talk a little bit more about this and tease it out on different levels. But if you have any questions of something you've heard about the market, the public, the private, what does that actually mean? How do I get invested? How do I get in and stay in? Please feel free to shoot us a text. You can text us at 602-989-5022.